Because in the long run, if you have much higher interest rates, you have to have higher inflation. 100% inflation goes with 110% interest rates. So the question is just how do we get there if we get there in the long run? And whether higher interest rates can lower inflation without help from fiscal policy. Can the central bank do it all on its own? What I mean by that, when they raise interest rates, that raises interest costs on the debt. Someone's got to pay for that. And so fiscal policy has to tighten with monetary policy. And a lot of the experiences we've seen have been times that combine fiscal policy, monetary policy, and economic reform. That's what really helps inflation. It's not obvious the monetary policy can do it all alone.
And you pointed to this orthodox economic argument that interest rates have to be higher than inflation in order to bring down inflation, but they haven't been typically in this period. Does that give credit to your argument?
That's another good point. The standard view is that to bring down inflation, you have to repeat the early 1980s. Interest rates much higher than inflation, and a recession and a painful period. Yet we're seeing now inflation coming down without super duper high interest rates and without recessions around the world. That fits with my view of inflation, but that does really challenge the orthodox view of inflation.
What evidence is there for this orthodox view of inflation?
Well, you're asking me evidence for the view that I don't hold. I view inflation mostly as a fiscal phenomenon. I have a book, The Fiscal Theory of the Price Level, right behind me here that argues that. And that's the sense in which I'm a little less than orthodox. The standard story does focus on 1980. High interest rates and monetary tightening brought down inflation. But other things happened in the 1980s as well. Tax reform, microeconomic reforms, much stronger growth. And if you look at the history, 1980 was a successful but joint monetary, fiscal, and economic stabilization.
Are we then now operating with outdated economic principles?
Oh boy, well, I like to think so, but everybody touts their own theory. We are operating, let's put it objectively, in a region of much less certainty of how the system works than certainly central bankers would like you to think. There's some historical experience and wisdom that says higher interest rates lower inflation. The empirical evidence on that is a lot shakier than you would think. There are many times when inflation came right down without high interest rates in the past as now. So there's, I think, fundamental principles, but a whole lot less technocratic competence than from the central bankers. Now, to be fair, when we don't really know what's going on, they still have to steer the ship, and I can sit in my office and complain about things.
Our former central bank governor, Philip Lowe, argued that the extreme short-term pain that some households are feeling because of high interest rates would be far worse if the RBA didn't lift interest rates enough to contain inflation. I guess the implication here is that rate rises work, even if they're felt unevenly across the country.
Well, I think, we've been arguing whether or not rate rises work and to what extent rate rises need to be accompanied by fiscal discipline in order to work, and whether they need to be accompanied by economic revitalization to work. But it is true that inflation on its own is very damaging, and the government needs to do something to stop the inflation, and that's going to hurt some people and help other people, and that's right. Basically, people who bet on there being no inflation are going to get hurt, and people who took precautions against inflation are going to do better. But the government has to get the macroeconomic situation under control, even though some people get hurt by it.
In Australia, we've seen inflation on an annual basis peak at 7.8%. It's now 4.1%. We've had 13 rate rises. They look like they're working.
Well, there's always the question of did you just jump in front of the parade or not? I do think the rate rises help. So my analysis of inflation, and this is in things I've written, and I'm not just making it up. Primarily, we had a bout of inflation in the US as in Australia, because in the US, we printed up $5 trillion of money and handed it out in the pandemic. You hand out $5 trillion worth of money, you're going to get inflation. The price level is going to go up and inflate away a lot of that debt. It's no magic, no greed, no shrinkflation, none of the usual suspects being written up. Now, once there's a one-time handing out of money, and that inflation kind of goes away on its own, which is also what we're seeing without tremendous action by central banks. Central banks help, and if you analyze the full view of the world, raising interest rates brings down inflation faster, but it would have come down on its own. On the other hand, our fiscal policies are not in great shape, and we are now sitting at higher than 2% inflation that I feel may be a little bit impractical. The danger, I won't try to forecast anything. The danger is to repeat 1975. If you go back and look at those numbers, those of you who are wonks, inflation came down without big rate rises, and then it went right back up again in the next big shock. So how are we going to deal with the next big shock without even more inflation, I think is a danger that we're facing now.
There are a lot of people feeling quite a lot of pain economically now. Did we not need those 13 rate rises?
That's a good question. Eventually, interest rates have to follow inflation. You can't let inflation be 10% and have interest rates stuck at 0%. And we have not had pain. Actually, the pain has been a lot less than people thought because the rate rises stayed below inflation. You are still getting, as long as interest rates are below inflation, they're paying you to borrow money. And we did not get the huge recession, huge job losses that we had in the early 1980s out of it. So right now, it's about as painless as it gets. And if you took out a fixed rate mortgage, good on you. If you had a floating rate mortgage, well, you were betting that interest rates would never go up, and now you're hurting. I'm sorry for that pain, but it's much less than the standard pain of getting rid of inflation.
Well, it's widely accepted that the government stimulus that we saw both here and in the US in response to the COVID pandemic was, at least in part, responsible for the inflation that we're seeing. But it seems central banks are being relied upon to pick up the tab rather than governments.
That's exactly right. And that's why, inflation may be coming down, but prices are still 15, 20% higher than they were at the beginning of this whole business. So yes, fundamentally there was a fiscal problem. We counted on central banks to mop up the damage. There's limits. Our central bank slept for a year before it did anything about it, but then when it did anything about it, it did help. But there's limits to what central banks can do. So it's now the business is fading away until the next shock hits.
On the fiscal side of things, in Australia, we're running very small surpluses. Our Treasurer, Jim Chalmers, today was talking about the fact that the government is still striving for a surplus. I mean, with that in mind, do you think Australia could be in a better position than the US that's running deficits when it comes to the inflation outlook?
Yes. Now, it's dangerous to comment on Australia. I hate being the kind of American who goes around the world telling people how to run their countries. If you run your own country, you're doing great. But the main issue, the point, which is a very good one to make, what matters is not this year's deficit or next year's deficit. What matters is not accounting gimmicks to push things in and out of the deficit window and make it look better. What matters is structural surpluses over the 10 to 20 years that it takes to repay debt. Inflation fundamentally comes from more government debt than people think the government will be able to repay, but to repay over the long, long, long run. So the danger I look at in the U.S. is the structural deficit. We have health and retirement promises that we don't know how to pay for. So 5, 6, 7% primary deficits as far as the eye can see. To the extent that Australia does not have that problem, then you have the capacity to borrow and to promise people that, to give people the confidence that government debt is worth it, that it'll eventually get repaid. You still have a lot of debt. You're in the 60, 70% of GDP. We're in the 100% of GDP. So it would be better not to have that. But you can have a lot of government debt if people have confidence in the fiscal policies of the country that debt will get repaid over decades. And that's the crucial thing, and the crucial thing that the U.S. lacks right now.
So what's the key takeaway here? That there's been too heavy a reliance on central banks to address inflation and that the government needs to step up more?
Yes. What we just experienced is a classic fiscal theory of inflation. I'm the luckiest guy in the world because I wrote a book on this and they did exactly what I said not to do and it worked exactly as promised. You print up $5 trillion worth of money, hand it out as checks, you're going to get inflation. That inflation fades. The central bank can help that along a little bit. That's exactly what we've seen. So that part of inflation, central banks are not completely powerful for inflation. You need fiscal policy to be sober, to at least let central banks do their job and to control monetary policy. That's the central truth. And central bankers don't necessarily like to be told they aren't all powerful, but they're not. And, we need, this is not your grandmother's economics. You need competent, sober economic policy in all dimensions if you're going to have permanently low inflation.
Do we need central banks?
Oh, absolutely. Well, I have written that Argentina might well dollarize. Small countries don't necessarily need central banks. California doesn't need a central bank. So there's this question of what the optimal currency zone is. But a central bank to manage a currency is, yes, that's a fine institution and needs to be run competently. The question is, can that central bank alone control inflation if fiscal deficits are out of control, if the economy is overregulated and not growing well? They can't do everything. Even the Argentinian central bank can't stop inflation with their fiscal policies. But a central bank is a very important part of good monetary control.
The Reserve Bank obviously values your thinking, and that's why we found your paper in the first instance. The current economic thinking is based on principles that date back to around the 1970s. Is there a need or even an appetite for rethinking those?
Absolutely, there's a need. And there's the current doctrine, as you're right, comes sort of out of the 1970s, is this verbal idea: higher interest rates cool the economy, and then through some sort of magic of the Phillips curve, that brings down inflation. The actual equations of the models don't look like that and don't work like that. The empirical foundations of the whole thing are kind of a shambles. So absolutely, I think we need better. That's what I spend my life doing. That's why I write books on the topic, which are imperfect and foundational. So central bankers have to do what they can while economists think hard about these questions. But they're time-honored and wonderful questions. Plenty to learn in this world as an economist.
John Cochrane, thank you for your time.
Thanks for a great interview.